Importance of cash flow quality analysis. Cash flow quality refers to the extent to which reported cash flows accurately reflect a company's underlying economic performance and its ability to generate sustainable cash in the future. While earnings can be influenced by accounting estimates and accruals, cash flows are generally more difficult to manipulate and therefore provide an important check on earnings quality. Analysts evaluate whether operating cash flow is sufficient to support reported earnings, capital expenditures, debt obligations, and dividend payments. High-quality cash flow is characterized by strong, recurring operating cash generation that aligns with the company's business model and reported profitability. Persistent discrepancies between earnings and cash flow often warrant further investigation. Indicators of high and low-quality cash flow. Several indicators help analysts assess cash flow quality. High-quality cash flow generally comes from operating activities rather than financing or asset sales. Companies that consistently generate operating cash flow in excess of net income often demonstrate strong earnings quality and efficient working capital management. Conversely, warning signs include negative operating cash flow despite positive earnings, excessive reliance on borrowing to fund operations, repeated asset sales to generate cash, or unusually large changes in working capital accounts. Analysts should also evaluate the sustainability of operating cash flow and determine whether improvements result from genuine business performance or temporary factors that may not persist. Cash flow manipulation and analytical adjustments. Although cash flows are generally more reliable than earnings, management can still influence reported cash flow through timing decisions and classification choices. Examples include delaying payments to suppliers, accelerating customer collections, securitizing receivables, or classifying operating cash flows as investing or financing activities. Such actions may temporarily improve operating cash flow without enhancing economic performance. Analysts should therefore examine relationships among cash flow statement components, changes in working capital accounts, and disclosure notes. Comparing operating cash flow trends with revenue growth, earnings growth, and industry benchmarks can help identify potential distortions. Adjustments may be necessary to estimate a company's normalized and sustainable cash-generating ability. Understanding balance sheet quality. Balance sheet quality refers to the reliability and economic relevance of reported assets, liabilities, and equity. A high-quality balance sheet faithfully represents the company's financial position and provides useful information regarding liquidity, solvency, and future performance. Analysts evaluate whether assets are appropriately valued, liabilities are fully recognized, and accounting policies reflect economic reality. Significant estimation uncertainty, aggressive accounting assumptions, or omitted obligations can reduce balance sheet quality. Because the balance sheet serves as the foundation for many financial ratios and valuation models, understanding the quality of reported balances is essential for accurate financial analysis and investment decision-making. Evaluating asset and liability quality. Asset quality analysis focuses on whether reported assets are likely to generate future economic benefits at their recorded values. Analysts assess receivable collectability, inventory valuation, impairment policies, fair value measurements, goodwill balances, and the recoverability of deferred tax assets. Liability analysis involves identifying obligations that may be understated or omitted, including pension liabilities, lease obligations, contingencies, guarantees, and off-balance sheet exposures. Aggressive assumptions can overstate assets or understate liabilities, creating an overly optimistic picture of financial strength. Reviewing footnotes, accounting policies, and changes in estimates helps analysts determine whether reported balances accurately reflect underlying economic conditions. Analytical implications of balance sheet and cash flow quality. Evaluating both cash flow quality and balance sheet quality provides a more complete understanding of financial reporting quality than earnings analysis alone. Strong earnings supported by robust operating cash flow and a high-quality balance sheet generally indicate sustainable performance and lower financial reporting risk. Conversely, weak cash generation, questionable asset valuations, or hidden liabilities may signal elevated risk even when reported earnings appear strong. Analysts frequently adjust financial statements to improve comparability and better reflect economic reality. For CFA candidates, integrating cash flow analysis, balance sheet evaluation, and earnings quality assessment is critical for identifying potential reporting concerns, forecasting future performance, and making informed valuation and investment decisions.